work today. Last time I gave you some work to do. You never did the assignment. That's fine. You are not serious, huh?
No, I did it. I have the PDF. I don't know on which phone, but I'll have to send it back to you.
Andy, you must be serious now.
Yes, I did it, say.
When you want to spend 10 years doing the same thing. That's not good, isn't it? So when I give you some assignment, you must do the assignment and then we move on with our lives, isn't it? Okay. Now we want to do group accounts. So that there are certain things which should guide us. We need to have sufficient theory. So we'll cover first of all the theory, and then we move to the computations. All right. The assumption is that a company is not always going to remain one. Sometimes the investors would also want to venture into another business. So they also create another company. You understand?
Yes.
Maybe this is the philosophy of investments, isn't it?
Mm-hmm.
Where you need to diversify your portfolio. So you tend to spread your wings. For example, you may start as a car repairing business, an auto shop. Then you decide later on that, no, I don't want to just remain an auto shop, you know, an auto shop company. Why not venture into ice creams? So you may decide to then do some ice cream business. So if the company A is also being owned by, I mean, it is also interested into company ice. All right. It's either it buys ice, it can buy ice, or it can form ice just from the scratch. To say we have formed a company, or they can buy an existing business. That's what I'm talking about. So those are things we want to look at in this particular um, lecture. And our efforts will be focused on a statement called Statement of Financial Position. If we start from the statement of financial position, much of the work is going to be very, very simple because we'll be understanding what will be happening, what will be the financial impact of whatever transaction we entered into. So it's very, very imperative that we start at this level. Now, as an introduction, I think I'll have to hide this because it's taking much of our space here. Um, Upon completion of this chapter, you should be able to define and describe the following in the context of group accounting. And by the way, group simply means that the companies in question are more than one, isn't
Yeah.
it? Yeah, a group is a combination of more than one people, more than one things, something like that. So we need to know we need to know how, what a parent is and be able to describe a parent. So there are some people called, some things called parents, right? But remember, we are talking of companies. So there is a company that is called a parent. Then there is another one called subsidiary. Then there is this thing called control. then consolidated or group financial statements, non-controlling interest, and trade or simple investment. You should also be able to describe the components of and prepare a consolidated statement of financial position. So by the end, I'm not going to let you go before you show me that you can now prepare a statement of financial position or extract thereof. Extract thereof. Okay, sometimes the examiner simply says, just show me the part of the statement of financial position where non-current assets will be and their values. You should be able to do that, including the following adjustments. So you need to be able to articulate the following adjustments: adjustments related to fair value, internal group trading, unrealized profits, and acquisition pathway through the year. Obviously, this one is the examiner's favorite, goodwill, using the full goodwill method. All right. That is our work today. And this is actually preparing you for the upcoming examination. So if you play, if you don't pay careful attention, obviously you won't enjoy the examination or this paper in general. What is a group? A group exists where one entity, the parent, referred to as the investor, has control over another entity, the subsidiary, referred to as the investee. So one of the companies would be the investor. So in our example, we say that there is company A, and this company A is the investor. All right. And this guy A then formed or bought B, which is the investee. So the investee and parent should be should exist, should be there for us to say there is now a group. So in the examination, you may be given a scenario that talks of there are certain companies A and B who are competing in the same location and they share same customers, same business model, and so forth. Are these companies in a group? And what will be your answer? Hello?
Yes, sir.
What would be your answer?
I didn't hear the question, sir. Sorry.
Auntie, you need to pay careful attention, please. uh, okay, I said,
What?
I said, what's going on here? Trying to unmute. All right, when you want to talk, please unmute yourself there. It's fine. I've muted you and it's refusing to. All right, that's fine. Okay, my question was this. You are reading a newspaper, okay, and you heard that company A and B are in the same location. All right, they're in the same location. They do trade to the same market. They share same customers, and their suppliers are also the same. They supply almost the same things. Like for example, if we look at PN, I mean what is this? TM Pick and Pay, right? Yes, TM Pick and Pay and OK Zimbabwe. They sometimes share the same customer bases and so forth. And their business model is just the same. They are in the retail business. Is that clear? So the examiner says, are these companies a group? What are you going to say?
No, they are not a group
Why?
because they happens to be in the same location. Doesn't mean that they are a group, number one. And number two, we are not told that these companies, either of them, there is an investor or an investee. So
Yes, yes. Your reasoning is quite, encouraging. Where should I put this, man? Okay, your reasoning is quite good and encouraging. Yes, there is no association here. There is no parent, no the investee. Okay, there's no investor and investee relationship between the two companies, right? They are just companies, the same business industry, but it doesn't mean that they are related. There is no parent of another, right? Then you will also be given a situation where company A and company A and company B are owned by the same person. They are owned by the same person. Can we say, can we say because of that, they are a group?
since they are owned by the same company, we cannot actually say that they are a group because we are not told that the company A and company B, they're actually related, or the company A is an investor, company B is an investee.
Good. There is no enough information. All right, that
Yeah.
question is not clear. So you need to pick that they are not a group because the information available there is only telling you that they belong to the same group. They belong to, to the same investor, but of the two, we do not know who was the investor and who was the investee. So for us to say there is a group, we need to know the parent. Exactly. Some companies might be part of the group, but they themselves, they are not really the group because we need to know the parent for us to say there is now a group. This is now a group. There should be the parent and the investee. There should be the investor and the investee. Is that clear?
Yes, it's clear.
In accordance with IFRS 10 consolidated financial statements, three criteria, three criteria are specified that must apply if one entity is to have control over another as follows. So this investor is a company that has got control over another company. It's very, very important, right? The investor has got control over his investments. So he should be having control in the following manner. The control is in the following manner. The investor should have power over the investee. Power over the investee. Power over the investee is normally exercised through the majority of voting rights. Okay, they can vote to say, no, your directors, we don't want them. Please remove them and put these ones. They have that power through the majority of voting rights. So at an annual general meeting, they may say, um, we want ABC to take place. We want you to acquire company D. because they have got the majority of voting rights. You know, the issue of voting. If you are many, you are going to outweigh the minority, isn't it? So if you own more than 50%, even if you don't exercise any discretion, if you don't want to exercise, you may decide to keep silent, but it doesn't mean that your silence shows you are weak. No, you are very powerful, but you just don't want to exercise it. Exactly. So if one has got more than 50%, because at law, they are recognized as the majority and their voice count. Now, this power, I mean, this control can also be determined if the investor has exposure or rights to variable returns from involvement. For example, a dividend. They've got a right which is variable, a right to variable returns. And I want, maybe you may be asking and saying, so say, what about if I have got rights to fix the returns? Am I not powerful? Am I not in control of the investment? What will be your take? Which one do you want, variable or fixed?
I think I'll go for the variable ones
Why?
because the fixed they don't have much rights as these variable ones.
Why? Or how? Okay, you are right. If you are earning or if you have got exposure or rights to variable returns, it simply means that when the company makes more profits, you are going to get more. But on the downside, if the company is making losses, you are also going to suffer losses. So, in a way, you are the owner, isn't it? The owners suffer. Owners enjoy in good times. That's the rule of business, isn't it? So this is why we are saying that these guys have got control. If the company makes more profits, they are also in charge of those profits. They are also entitled to them. The only bad side is that when the company is in the bad situation, then they are also going to suffer the consequences of bad business. Lastly, the investor has the ability to use power over the investee to affect the amount of investor return. So these people say, no, this time we want 30% return on our investment. You need to lift our return from 10 to 30%. So they have that power. So all these are the elements which determine that the investor has control over the investee. Please bear in mind that this is the third point here is actually the crucial determinant in deciding whether or not control is exercised. That is in terms of IFRS 10. What is IFRS 10? If I may ask. What is IFRS 10? So you're not reading your standards, right? Hello? Eddie? Andy?
Sir, can you hear me?
I can't hear you. I think it's because of the muting. I was playing the muting buttons here. If you unmute, you are not. You are muted. So unmute. I'm trying to unmute from this end, but hey, man, it's giving me a hard time.
Now, can you hear me?
Yes, I can hear you now.
IFRS 10 is about consolidated statements, isn't it?
Yes, yes, yes. But what is its name? What is the title of the standard?
Consolidation of financial statements.
Yeah, you are there. You are almost there. You are there. I want you to know the name of the standard is part of your homework. All right, let's move on. Um, Further definition. So, what is the parent? The parent company is the company that controls the other company that controls, and we have just been discussing of what control is, and we now know what control is, isn't it? Good.
Yes.
Uh, Subsidiary company. This one is the company that is controlled by another company. What about consolidated accounts? These are the accounts for the whole group where we treat the group as one single entity, one big family. All right.
Yes.
Non-controlling interest if the parent company does not own 100%. If the company owns less than 100% of the subsidiary, then the part owned by others is known as non-controlling interest, NCI. All right, so it's it is quite common that companies buy, say, 55% of another or 60% of another company, 80%, and so forth, but not the full 100%. So in that situation, we say that there is NCI in existence. There is NCI in existence. Okay, there will be some NCI, the non-controlling interest. A trade, excuse me, a trade investment, on the other hand, is one which the investor neither a subsidiary, one in which the investor, right, is
Mm-hmm.
neither a subsidiary or an associate. Actually, here is the investment, is the one in which the investment, not investor, in which the investment is neither a subsidiary or an associate. It is accounted for as financial asset and normally measured at fair value at each reporting date. All right. Okay. We now know that a subsidiary is where we have got more than 50% as a basic. Okay. For now, if we own more than 50% of ordinary shares in another company, that company is our subsidiary. Am I talking sense to somebody?
I didn't get that clearly.
If we own, if we
Mm-hmm.
own ordinary shares, or if company A owns ordinary shares, which are more than
Mm-hmm.
50% in another company,
Okay.
then then that company is company A subsidiary. It is a subsidiary company. Is that clear?
Okay. Yes.
Now, we are being told that there is a company called an associate. Have you seen this? An associate is where we have got shareholding, which is uh 20, where we've got 20, uh but less than uh 50%. 20, but less than what? 50%. Okay.
Mm-hmm.
We'll talk about associates later on, but they are normally between 20 and 50%. All right. So any investment now is where you have got one, two, uh, to say 19%. You own 19% of another company. That's an investment. It's a simple investment or a trade investment.
Okay.
Is that clear?
Yes.
But like I said, the percentages themselves do not mean anything. You need to know the aspect of what is control. Here, when we have got 20 but less than 50, we have got what is called significant influence. Significant influence. All right. For example, when
Mm-hmm.
it comes to the appointment of directors, if the company's board of directors has got 5 in total, but we can only appoint not more than 2 directors on that board, then we only have got what is called significant influence. We can influence significantly, but we do not have control. The people who have got control are those ones who can appoint 3 or more, because it's out of 5. So if we can appoint 3 or more directors, then we are in control, isn't it?
Yes.
So a subsidiary is controlled, and we say that prima facie, to see that there is control, at least there should be more than 50%. But you need to read further, because there are some companies who can be owned uh, by more than 50% shareholding, but there would be certain clauses that limit the control to something else. So you need to read further. But for now, at this level, let's just assume that if the investment is more than 50% shareholding, then that is a subsidiary. If it is less than 50%, but more than 20%, then that that is an associate. Okay. Then
Mm-hmm.
if the investment is just less than 20%, that's a simple investment. Is that clear? Hello?
Yes, sir.
I know it's not a yes, but you are just getting rid of the same. Uh, so the purpose of consolidated statement of financial position is to show all the assets and liabilities that are controlled by the parent, effectively as though it is one big family. Let's go through the following example. So we have got example Paraza here, example Paraza. On 1 January 20X8, Paraza that is P, acquired 100% of, can't see something. So, acquired 100% of the ordinary shares of Sharia, which was incorporated on that date. So, the company Sharia was incorporated on that day, which means was formed on the day it was acquired. Okay, so it's like Parazza just formed another company. That's what it means, isn't it?
Mm-hmm.
Uh, on 31 December 2010, the statement of financial position of each of the two companies were as follows. So 2 years later, can you see this? It's almost 2 years later,
Yes.
isn't it?
Mm-hmm.
So the non-current assets were 25,000. Investment in S, that is Shadia. Investment in Shadia was 10,000. So nobody's going to tell you that Shadia was bought with $10,000 or for $10,000. Nobody is going to tell you that. So sometimes you need to lead yourself using the figures, okay, and the language they use. They are saying investment in S, so that was the amount which was paid to invest or to buy S. The current assets with those ones is given share capital. That one, prepare a consolidated statement of financial position at 31 December 2010. So what do you have to do? You want to prepare it? I'll give you the rights to share.
No.
Why don't you want to do that? Tell me.
Ah,
Why
this
don't,
this this
why
this
don't
is
you
the
want
reason
to?
why
Uh,
it's still vexing me.
well, Pela, aren't you are about to write Pela the exam, isn't it?
Yeah, I know. At least if you
In
can show me this, the next question, I think I'll be able to do it even better.
the next question.
Mm-hmm.
So one thing I want you to understand is that this camera was bought on the same date it was created. It is it it won't sound nice to think of goodwill on a company that is has never traded, has it won't sound nice. So here it's actually a straight jacket type of thing, right? It is a straight jacket type of thing because it was bought on the same date it was created. So we just assume that uh, the example here is just meant to tell us what consolidation is all about. Consolidation is about, adding across. It's about adding line items. So, for example, non-current assets for P simply means that in a consolidated, in group accounts, in group SFP, we are going to have these guys added together. So 25 plus 12, this comes to 37, isn't it?
Mm-hmm.
But because this one is a consolidated statement of financial position, we are not going to see investment in S because investment in S was only being seen in the parent single, own balance sheet. In the parent's books, the parent, remember, will also have to prepare its own accounts. The subsidiary prepares its own accounts. But the group will then have to merge the two into one. Is that clear?
Yes.
So in the eyes of the group, we just have to see companies merged together as one. So we don't expect to see a
Sure.
statement like investment in S because the group does not invest in S. The group is investing in both the parent and S, so they have to be merged as one. Is that clear? So that this one is out. Also, what is out? I said this one and also this one. Why is it out? Because we only see the share capital of the parent. Because this one is the major owner, is the owner of the group. So their share capital is the only share capital to be reported. Am I talking sense?
Yes.
So we don't want to see the subsidiary share capital, even if when you are going at later stages where these subsidiaries will be two or three or more. The only share capital to be seen in the consolidated statement of financial position is that of the parent only.
Oh, okay.
Hello?
Okay, yes, I get you.
Am I being heard?
Yes.
Good. So obviously, under exam situation, under exam pressure, time won't be on your side. So you just have to, there are certain figures you just have to know that these ones should just come as they are. 25,000. The share capital
Okay.
there. Then you add across, as I indicated, the current assets. We need to add these ones through. Let me use the calculator here. That's 17, isn't it?
Mm.
Then we add up 4, 5. Uh, for the share capital, we say that we need to take the figure as it is, which was 5. Retained earnings, we add them across again. That's 23,000. Then the current liabilities, we add them across 6,000. But there will be workings for these figures where where there have been certain trading, the intra-group transactions, all those on the current accounts, which we talked about in the introductory part of this lecture, that those adjustments will need to be catered for, even for the fair value at acquisition. All those would be considered, would need to be factored in to moderate these figures. But for now, nothing much would have happened because the subsidiary was acquired on the date of incorporation. It had never been into any business. So if you add across, you need to balance. Make sure you find 54,000 there. If there is no 54,000, then something would have happened wrong. So 54,000. Do you get the idea? Have you got the idea?
Yes. Mm.
Some people want to join. Let me give them the link. Oh, they've gone. That's fine. How can you expect to watch this live stream without data? That one is impossible, isn't it?
Yes.
Somebody say, "Oh, we don't have that." So what shall we do then? Oh my God. Anyway, let's move. Let's move. So that was the solution, and we did that one, which is fantastic. Now, pre-acquisition profit. In the previous example, Parada had acquired Shadia on incorporation date. Very often, a company acquires another one after some time. So if we acquire another company after some time in trade, there is what is called pre-acquisition profit we need to consider, because there would be other profits that company would have made. And profits accumulate in an account called retained earnings. Have you ever heard of that? Hello?
Yes, sir.
Have you ever heard of what is called retained earnings?
Yes.
Good. That's where the profits made by the company, which are not reinvested back into the business, they accumulate in a retained earnings account. Now,
Okay.
there is this animal called goodwill. I said this is the examiner's favorite. It's quite rare to come out of the examination without being required to compute goodwill. It's very rare.
Mhm.
They always ask you to calculate it, isn't it? So in the
Mhm.
previous example, the amount that the parent paid for the subsidiary was equal to the value of the subsidiary, is shown in the statement of financial position. Yes. Um, However, there are two reasons why the parent may have paid more than that amount. Remember, the share capital of the subsidiary was 10,000, and
Mhm.
the company paid 10,000 as the investment, isn't it? So in that situation, we don't expect the computation of goodwill. All right. The assumption is that there was no goodwill. They just paid what was the ordinary amount. But there are situations when the company, under which the parent P would have paid more. There are many reasons why P might have, in other situations, paid more. One reason is that the non-current assets may have been worth more than the carrying value. Sometimes when we were given the list of the assets which were being owned by the potential subsidiary, the assets could have been undervalued. For example, land and buildings might not have been fairly valued, right? So if they had been at fair value, we would expect the parent to have paid more. All right. The second
Mhm.
reason is that the parent company may have paid more than the fair value of the assets and liabilities because they were acquiring what is called goodwill. Sometimes, even if the assets were going to be fairly valued, we were as well going to pay more than the fair value of those assets. And this is, that extra premium is what is called goodwill. For example, you come to buy my company, and I say, you hired an expert to value all the assets of the company, and they tell you that they are worth $100, but you still insist to pay $200. The extra premium is what we are considering goodwill. Is that clear?
Okay. Okay. Yes, yes, it's key.
Goodwill is not really the value of the assets, but it is the premium above the total assets of the business at acquisition. Hello?
Okay.
You would have paid money for the assets, but after considering the total value of the assets, on top, you went an extra mile and pay what is called goodwill. Hello?
Yes.
Good. So, This is why goodwill is called premium on acquisition. It is a premium, the extra charge over a charge above the charge of assets. That one you pay on top of the charge of the asset. That's the premium we are talking about. So in the books of accounts, it is considered an intangible asset. In the consolidated statement of financial position, this one is called intangible, an intangible asset. What is intangible asset? It is an asset with all the other attributes of any other asset, but the problem here is that it is not physically touchable. You cannot touch it, isn't it? You cannot even see it, but in the economic sense, you are seeing it, so you need to recognize it easily. Hello? Intangible means you can't touch it. Hello?
Yes.
Good. Now, accounting for goodwill. Firstly, in the books of the parent company on consolidation with the subsidiary, the following entries are made, which means when company P acquires share, it debited the investment. This is why we saw 10,000 under the non-current, under the
Non-current
non-current
asset.
assets, right? It was debited, yeah, but it was an asset, it was considered an asset. In the parent's books, it is an asset. The company itself, the subsidiary is considered an asset, an investment. Then, because money left the bank, we credited bank $10,000. Are you seeing that?
Yes.
Good. Now, when we crossed over the bridge through the consolidated financial statement, in the statement of financial position, we are debiting an asset. This asset is an intangible asset called goodwill. Intangible. This one is an intangible asset called goodwill. So we are debiting the asset called goodwill and crediting bank or consideration transferred. You see the mathematics as we do an example. All right, sometimes the money paid to acquire another company. Sometimes we use cash to acquire another company. All right. This might be relevant or not relevant to this examination. So we might ignore it, but maybe let us just talk of this other acquisition method, the share for share exchange. Sometimes we buy another company using our own shares, not really using our own money. Is that clear?
Yes.
I'm yet to ascertain if this one is part of this syllabus for you because I don't want to confuse you. All right. All right. So we may use share for share, that is using our own shares to buy the shares of another company. All right. But that one, let us leave it aside. The rest, let us just ignore this. All right. Until maybe I find a question, then I'll tell you when I find a question where those things were required. But for now, let us just ignore that one for now. Let us assume that we paid cash. Exactly.
Yes.
Let us assume that whenever we are talking of consolidation, the company paid cash. Let me respond to that there. So we are going to say because cash has left us, we are crediting bank and debiting and debiting. obviously the goodwill, the goodwill, which is the intangible asset. All right, we have talked about that one. Let's move on to this. We've got a company called Pedro, a company called Pedro, which purchased all of the share capital, that is $4,001 shares of Syracuse Company for $60,000 in cash. The statements of financial position of Pig Company, that is Pedro, and Syracuse Company prior to the acquisition are as follows. So these statements were prior to the acquisition. All right.
Yes.
So prior to the acquisition, we can see that Pedro had PPE 100, whereas Syracuse had 40,000 worth of PPE. The cash at bank for Pedro was kissed. For Syracuse, the cash was zero. Then the total assets was 40. Okay, 160, that's 100, that's 60, and you get that one. Then the equity share capital, 40, and then 160. Now, we have got additional information here. First of all, we will examine the entries made by the parent company in its own statement of financial position when it acquires the shares. So the entries in Pedro's books, that is the parent, would be debit investment in Syracuse. Why? Because we have invested in another company, and that company in our books is an investment. So an investment is an asset. So we are debiting investment 60,000 and crediting bank. Why? Because money has left us. So Pedro Company's individual statement of financial position will look as follows. That is, we'll see the PPE as originally stated, which is 100,000, and then it is increased by the investment in Syracuse, and we come to the total of that one. Then the share capital will still remain as it was. Share capital and liabilities, those two remain as they are. Let us see how it will turn out to be. Now, when the directors of Pedro Company agreed to pay 60,000 for 100% investment in Syracuse Company, they must believe that in addition to its non-current assets of 40,000, Syracuse must also have intangible assets worth 20,000. So when they paid, because the current assets were just 40,000 of Syracuse, we have seen that, isn't it? The current, the assets were just 40,000. But these guys, they paid 60. They didn't pay 60. Sorry, it's 100, right? So not this part, not this part. They paid, the investment was 60, all right? So they paid 60,000, all right? So in paying 60,000, they must have believed that there is an extra 20,000 benefit we will enjoy. We will enjoy in buying this company. So this amount of 20,000 over and above the value of tangible, that is of PPE, but PPE is tangible. Over the tangible or over the PPE acquired is called goodwill arising on consolidation or on acquisition. Is that clear? Now, so following the normal cancellation procedures, the 40,000 share capital in Syracuse statement of financial position could be cancelled against the investment in Syracuse, when we now want to do consolidation, it simply means that we need to cancel the investment portion with the share capital of Syracuse. All right. The share capital of Syracuse is, remember, is 40,000. Remember, the share capital of Syracuse was originally 40,000, but remember, when doing consolidation, the share capital is not going to be included. The share capital of the subsidiary is excluded. So that process of excluding it is cancellation. We cancel it with the investment. So the assumption is that this 40 is going to be cancelled with the amount of investment. And in this case, the amount of investment was 60,000. And if we cancel 40 from 60, we are going to be left with 20,000 extra. And that 20,000 is what we are calling goodwill. Hello?
Yes.
That 20,000 is the goodwill that is going to be left. So when we do the consolidations, we will say property, plant, and equipment, the 100 for the parent plus the 40 PPE of the subsidiary, and we arrive at 140. Then intangible non-current assets, now we are recognizing that extra 20 as the non-current asset, and the total assets will be 160. We move on to the share capital, and this one, no movement at all. So that's that's our statement. I mean, the consolidated statement of financial position. Let us attempt this one, and I'm going to give you how many minutes?
Mm.
You don't know. Everything is out there for you, isn't it?
Yes.
I have spoken everything for you. Let me remove this face of mine so that we have enough space. Are we going somewhere?
Yes, I think, yeah, we are going somewhere. So here the additional information is saying of D&J it's as at 31 December 20x8. So it's still the same financial year. At this date, J on this date, the fair value of 20,000. It was 12,500. So here said we have to do the group SFP,
No. We
or we
just
just
want
have to
to compute the goodwill
calculate.
and we move on. Just goodwill.
Oh,
All right.
just the good.
Just wait a bit.
Mm-hmm.
I'm just realizing something here that we didn't talk about is the computation of goodwill. Anyway, but I've realized that amai muri kutamba zvenyu nayo. because the assumption is that is the revision. In the revision phase, we expect that we will have covered ground, isn't it? Anyway, all right. So to calculate goodwill, there is a certain template you need to know. We need to know the fair value of consideration transferred. The fair value of the consideration transferred or paid, all right? You need to know that and follow this template. If you can write notes somewhere, well, this one is the favorite, is the examiner's favorite working. So fair
Okay.
value of consideration. How much was transferred?
60,000.
Yes, we transferred 60,000. Where is the 60,000? Where did you get it?
Investment
Yes,
shares. Okay.
the investment in J. Exactly. Good. Then
Yes.
we need to add any NCI. If there is NCI, here there is NCI because why is there NCI? Tell me, why is there NCI?
Because we only acquired 80%.
Yes, we acquired 80%, so 20% is the NCI. 20% is the NCI. At this date, J's retained earnings to the 20,000. On this date again, the fair value of the 20% NCI was 12,000. You are given by the examiner. So what you simply have to do is to pick those figures into your template, right? The NCI is added. Please don't deduct. It's add NCI. Add
Okay.
NCI, add acquisition. NCI at acquisition. The NCI at acquisition was 12,500. You add the figure, okay? You add the figure, don't give it any name, doesn't have any, any special name, this figure. So in the exam, you might not add and just go straight to the following entry. But anyway, I mean to the subsequent end. Now, 60,000 plus 12,500, that's 72,500, isn't it?
Yes.
Then you say less net assets at acquisition.
Yes.
The net assets at acquisition. So you need those assets at acquisition. Okay. So when you talk of these assets, the net assets at acquisition, we are talking of the share capital. We are talking of the reserves. Okay, we're talking about the share capital and the reserves. Now, reserves here, we will be looking at two things: the share premium, and the retained earnings, and other reserves. As you'll be proceeding with your studies, there will be a lot of reserves there. All right. But for now, we are talking of just two things: the share premium and the retained earnings. Those are the reserves and the share capital. So share capital is assumed not to change. The share capital and the share premium, they are assumed to remain as they are. That's the assumption you need to give. You need to tell the examiner, that's my assumption. That's my assumption. Even if there is no, the examiner would be knowing that that assumption holds. That unless told, the share capital was just as it was. Is that clear? The share capital
Yes.
of the subsidiary was just this amount, these two amounts, the share capital and the share premium, unless there is evidence that there were changes somewhere thereafter. But you just assume that they were just like that on the date of acquisition. Is that clear?
Yes.
Good. So for the share capital, we are picking 20,000. For the share premium, we are picking 10,000. Are you seeing where I'm taking these figures from?
Yes.
Good. Then for the
So
retained earnings, which figure shall we use? Talk to me, girl.
are we not supposed to use the one or for the parent?
No, we are talking
Here
of
we are dealing
acquisition.
with okay.
Yes, we are talking of the acquisition of the subsidiary J. We want information related to the subsidiary J.
J.
Mhm.
Okay, so we
This
take this
goodwill,
25,000.
remember, hello,
Mm,
hello, listen. Remember, the goodwill is on the acquisition of the subsidiary J. We are talking of subsidiary J.
okay.
Okay?
Yes.
So, we have picked the share capital, share premium, and those figures. I said these are the figures which are expected not to change. But the rest
Okay.
will fluctuate. The rest will fluctuate. Is that clear?
Yes.
So we want the retained earnings at acquisition, and these ones were given here. The retained earnings on the date of acquisition were 20,000. Okay?
Oh, all right. Okay.
Okay.
Yes.
So we add up and we get the total net assets at acquisition. These were the net assets at acquisition. The other term for net asset, we are talking of the equity. The equity at acquisition, the residual interest in this company was that one. So after remember the residual interest equity is the residual interest in the company's assets after deducting all the liabilities. So you will realize that this figure I'm calling equity. Remember this is the equity. This is the equity we are talking about. So if you deduct liabilities, I mean, from the assets of the business, the assets, for example, these are the total assets, isn't it? And
Yes.
if we deduct these liabilities, where are the liabilities? These ones. These are the liabilities. You will still have to come to the I mean the equity, the total equity, this figure. This is the total equity I'm talking about.
Mm-hmm.
Okay. I hope I'm not confusing you. If you deduct 102, I mean, if you deduct 47, this is the liability from this, you must come to this. Okay?
Yes.
Try that. Try that. 102 minus 47, you should come to 55.
It's 5.
Okay, so that is the same
Mm,
trick we are using here. We are saying net assets at acquisition now. At acquisition, the net assets were 20 plus 10 plus 20. This means they were 50,000. So this is the figure. This is the figure we are going to use to our goodwill computation. So I'm going to take that figure I'm going to take that figure and put it here as 50,000 as it is. 50,000, and I should get the total of goodwill here. Goodwill. My goodwill should be 22,500. So this company D, when they acquired this company D, when company D acquired 80%, when company D acquired 80% of company J, whose assets, the assets of company J were 50,000, as we can see there, but they paid 60,000. They paid 60,000. All right. And because it wasn't 100%, they should also know that there is an NCI. So the NCI is actually eating part of it. So in this goodwill, you would see that there are some traces. There are some traces of NCI. Okay, there are some traces of NCI, but if you remove the NCI component, you are going to witness that what the parent paid was actually the difference, which is 10,000 above the non-current, the net assets here, because we paid 60 and the assets were 50,000 at acquisition. So the premium actually, which the investors might say, this is our effort, was 10,000. However, because there is NCI to consider as well, we assume that because we are the controllers, we are controlling NCI. So the NCI control is actually going to be our part, because we are controlling everything. So the value of NCI when we acquired is also constituted in the goodwill. So it is considered, this goodwill is explaining our control over the NCI as well as the amount of investment which we paid. So we are going to acquire everything because we are also controlling the NCI. Their value at acquisition, we are controlling it, even if they are we can say shareholders in the company, but they do not have the power over us. So their value is also going to be incorporated. We paid something to acquire them. So all those, that combination is coming to what is called the goodwill at acquisition. So this was the way to compute the goodwill, which turned out to be 22,500. Any question on that?
No, it's crystal clear.
Now, let's hope sometimes you may calculate the figure and you obtain what is called negative goodwill. Negative goodwill is a gain or a bargain purchase. It is a gain. If it is positive, it is not a gain, it is an asset. But when it is negative, so when it is negative, it simply means that, for example, if we had paid, let us look for a scenario where it could be negative. For example, if we had paid 40,000, if we say 40, can it come to negative? Let's say we paid 30. Let us just be very, very pedantic. 30. If we had paid 30 consideration and NCI remains at 12,000, we were going to come to 42,000, right? 42,500 and minus 50,000. This means that we are going to rest at what? 42 minus 50. Isn't it 7,500?
That's 7,500.
Yes. So goodwill is going to be minus 7,000 what? 500. Negative, isn't it? Hello? Are you seeing that it is negative?
Yes, I'm saying it. That is negative.
So negative, you tell the examiner that this is negative goodwill. You write negative if you did not put a negative, because if it is already in the bracket, they will see that it is negative, isn't it? Hello. No point to tell them that it's negative when the figure is already negative. Am I talking to somebody?
Yes, sir.
So what is important is that you're not going to be penalized if you say negative goodwill when the amount is also in negative. You're not going to be penalized, but it shows that yes, you need to develop somewhere, isn't it? All right. Now you need to explain what negative goodwill is. You should be able to explain that, because remember that was also part of our objective, isn't it? You
Yes.
need to explain. So negative goodwill simply means that the amount we paid here, the amount we paid, the subsidiary, the consideration transferred was lower. So was lower than the net assets of the business. So we made a gain. We bought the business so cheap. So it is a gain. Hello? It is a gain. That would be a bargain purchase. We bought the things so cheap. So we are going to debit the investment as usual and credit retained earnings. No goodwill is going to be realized in the group financial statements. Okay, most likely the reason for negative goodwill is a misstatement of fair values. That would be the most likely chance. So the standard therefore requires that the goodwill calculated is reviewed to ensure that the correct fair values have been included. After such a review, any negative goodwill remaining is credited directly to statement of profit or loss or retained earnings. That is working number 5. If we are considering the statement of financial position, I think you need to be in a position to appreciate what is working number 1, working number 2, working number 3. I think there is that part we just have to talk about, and this is the issue. Now, in previous examinations during the paper versions, where we used to write this examination on paper, we were given some scratch pads, some extra paper to do the working, or sometimes you'll be required to do your workings in the exam booklet during that era. So in this era, no need. No drawing is going to be sufficient. It's going to be allowed. Nobody's going to give you a pencil to scribble on their computer screen. Nobody's going to allow you to do that. Is that clear? So
Yes.
we are going to do the drawings just to assist you to comprehend these things. All right. So we have a situation where a parent acquires 80% of the subsidiary. So you need to draw this in your mind that there is an 80% as your group structure. You need to establish the group structure as you'll be reading the question. Sometimes they will tell you that P acquired 40,000 of S 50,000 shares. So 40,000 of 50,000, that's 80%. So this is how you establish a group structure. Because sometimes the examiner is not going to tell you what percentage was acquired. You need to create it, to originate it yourself. Those are triple Taura, madam.
Okay.
All right, that's working number 1. We are done. Then the net assets of subsidiary at the date of acquisition. Bopa taita aba tikati isuzu equity share capital ye subsidiary yacho kuti yaiva mari, the share premium yakanga iri mari, and I said these first two, the share premium and equity capital, they are expected to remain constant. Even at the reporting date, you see that these figures will just be the same, the share capital and the share premium. But the revaluation surplus might move. This is another subsidiary revaluation surplus. This is another reserve. It's another reserve. are we together? Also,
Yes.
the retained earning is another reserve. They change these ones. They sometimes change. They do change. So you need to be guided accordingly. The total of issued share capital and share premium for the subsidiary statement of financial position should be unchanged at both date of acquisition and reporting. We have spoken about this. They shouldn't change. They're expected to remain as they are. Of course, as you proceed in your examinations, you discover that at times they do change. Is that clear?
Yes.
Sorry, I do not know what happened with this page of mine. Let me just try to correct it because it might end up confusing you. I don't like what this page is doing. Are you still seeing something?
Yes.
Okay, good. um, Sometimes happens, that's typing. Typing is always foreign to most of us. Okay. So when we are calculating goodwill, you first of all look at the consideration transferred, right? Or the consideration that was paid at fair value. Then fair value of non-controlling interest at acquisition, you need to add. This is adding, and you get the total. This is the total, right? If we are subtracting, we put brackets. So when you see figures without brackets, the assumption is that you are adding. Is that clear?
Yes.
Fair value of net assets at acquisition, that amount. So here we are subtracting. We are subtracting the net assets. And I told you this is how you create your net assets. And we've spoken about this. When this is the figure at acquisition, that's the figure you need to take and slot here as your deduction. That's the figure we are talking about. This is why we say this is from working number 2. So you pick that from this part. That's your working number 2. Anzikuza mwana upedzisira. Okay, now then after doing the computation, you get your goodwill. Then you move on to the non-controlling interest, which is working number 4. So the fair value of XCI at acquisition is actually going to be given from working number 2, number 3. This is when you get this from working number 3, which is that amount. So you take the same figure straight to this working. Now, where would you have taken this amount? Usually the examiner is going to give you as a straight jacket. Sometimes the examiner is going to tell you that the fair value of NCI was 30% of the consideration transferred. So you still have to take that one from the question. But usually, as you have seen in our example, the examiner is going to tell you that the fair value of NCI at the date of acquisition was this much. So you simply have to pick that one and you slot it in first in working number 3 and in working number 4. Sometimes examiners got angry if you fail to pass certain things. Like, for example, if you fail to recognize that the fair value of NCI should just be the same here, we are talking of the same thing. So if the figures become different, examiners will start to worry. Is that clear?
Yes.
Good. Now you need to add the NCI share of post-acquisition reserves. Now we are talking of post-acquisition. Remember, we account for NCI on acquisition, at acquisition, which was that first X we talked about, but there have been some movement. This is now the post-acquisition phase, the post-acquisition reporting phase, where we now have to then ask ourselves, the, the net assets at acquisition were X, but now at reporting date, the at reporting date version is this part. Let me take you back here. This is the post-acquisition phase, because you'll be given, this is the the statement of financial positions, the statements of financial position of D and J as at 31 December. And this is the reporting that is today, okay? So they will be this much. These are the net assets at the reporting date. But previously, remember, we calculated them incorporating the retained earnings at acquisition, which was some time ago. But here now, this is the reporting phase, the post-acquisition. Things which happened after acquisition, they are the post-acquisition events or transactions. Are we talking to somebody?
Yes.
Good. So let's say at acquisition, they were 10,000. Okay, these were $10,000 at acquisition. Now, post acquisition, they are now $20,000. Initially, they were 10,000, but now they are 20,000. We have done the additions and they are standing at 20,000. What was the movement here in total? There was a gain or increase. There was an increase in reserves or in net assets rather. Let us just say increase in net assets of how much? How much was the increase?
10.
Yes, 10. How did you get the 10?
20,000 minus 10.
Good. So 10,000 increase. So we need to share this one. Like I told you, this 10,000 is not only for us, it's not only for the parent, it is also, it is not only for the group, it is also for the NCI. So this should be shared between the group and NCI. In what proportion? In the shareholding proportion. So the group is going to take 80% and the NCI is going to take 20%. Am I talking to somebody?
Yes.
Good. So this is here we are saying the NCI share of post-acquisition reserves, and in our example, this would be 20% of the post-acquisition increase in reserves, which was 20% of the 10,000, which was the increase, isn't it? And you get your 2,000 here. This is the movement in net assets between acquisition and reporting debt. That is the share we are talking about, the movement. So you need to multiply that movement by the NCI percentage. You will see that, you may be asking yourself to say, so where does the 80% go? The 80% goes here at the group retained earnings. We first of all include the parent's retained earnings, the parent of the parent as they are. Remember, where is that example? If we come here, the parent has its own retained earnings. So when you do the retained earnings working, you first of all take this, do not miss this. the parent's retained earnings. Then you add the subsidiaries' retained earnings. The only danger is that, remember, in our previous example, the first example, we added across. Now, if you simply add across and forget the pre-acquisition, you'll be lying to yourself. So you need to adjust the pre-acquisition. So you may add and then subtract the pre-acquisition to get the post-acquisition. So that's what we're talking about. Is that clear? Good. So you must start with the retained earnings of the parent. Now you come back and put your parents' retained earnings there. Then the percentage of post-acquisition share of the the subsidiaries net assets movement. So the movement, remember, in our example was 10,000. So this should be 10,000 multiplied by 80%. And you get the post-acquisition figure there, your X. You add that up and you get your group. This is for the group retained earnings in the group consolidated financial statements. Remember also that there are a lot of adjustments to be made, as you shall see in the coming example. I think we now have to go straight to the example which can seal everything on one place. Is this the example I want? Is this the thing I want? I don't want this one. Okay, so the shares sometimes could be asked in our examination. So we need to talk of the shares, right? Where we use the shares as our consideration. We need to talk about this example. Let's talk about this example where shares are involved. P Company has acquired all of the share capital of S Company, that is $12,001 shares, by issuing 5 of its own $1 shares for every 4 shares in S Company. So they acquired all of S share. So if the ratio is saying that we acquired 5 or 4, 5 for every 4, it simply means that if the subsidiary had 100,000 shares and we acquire 5 for every 4, how many shares have we acquired? How many shares have we acquired and how many shares have we issued?
12,500. Oh, it's 100.
Yeah.
125,000.
We would have acquired 125,000.
Mm-hmm.
Is that so?
Yes. And it's
I
5
think
over 4.
I think we are wrong somewhere.
Mm.
I asked the 2 things: how many shares issued and how many shares we acquired. Issued and acquired. Shares
We
acquired.
acquired 1,000.
We only acquired. We acquired how many
12,000.
shares?
12.
Hmm?
12,000 of dollar each.
Shares acquired are only 100 over 4, isn't it? we issued 5 for every 4. So, so how many shares we acquired? The shares which we acquired were 100 over 4, which is how much? 2?
25.
25,000, right? So 25,000 we actually acquired from the South, isn't it? All right. But how many did we issue? We then say 25,000, which we acquire multiplied by 5. Because we were giving them 5 for every 4. So this one is actually the mathematics for the number of shares issued.
So it's equals to 125.
All right, 125, huh? But you were saying that one on the shares which we acquired, but not shares which were issued. That was our problem, isn't it? So for issue, you use this formula. This is the formula you need to use. All right. The number of shares issued over the amount, the quantities of shares to be acquired, multiplied by the total number of shares from which the acquisition is to take place. Let us see what they are saying here. The market value of P company shares was $6 at the date of acquisition. All right, so share had 12,000 shares. Have you seen that? This guy had, this subsidiary had 12,000 shares. All right. Now, P company was issuing 5 for every 4. So let me remove the jacket. It was cold in the morning, but now we are chisel.
This side it's still cold.
Oh, it's very cold.
Yeah, it's very cold.
Don't worry, it's gonna be warm. Now, so the market value of the companies, of the parent shares were $6 at the date of acquisition. So we use the market value to value the share, but we are valuing our own share, the parent share. We are using the parent shares to value those shares which were issued. We issue share. So the quantity of shares we have determined them. How many shares? We are going to say 5. The number of shares we are going to issue are 5 over 4 multiplied by 12,000 shares multiplied by the share price. What is the share price? $6, isn't it? My pen is now misbehaving now. It's tired. Okay, so if we punch the figures, 5 over 4 multiplied by 12,000 multiplied by 6, $6, not 6,000. It's $6. What do we get? We get 90, isn't it? So that is the fair value of the consideration transferred. So what is the double entry? The double entry is going to be investment in S. That's 90,000. We have been doing this. And we then have to create or to increase the share capital account. Why? Because we have issued, excuse me, we have issued shares. So we are increasing. That's the reason that might cause the share capital movement. So we have increased the shares by how much? We have increased by 12,000 multiplied by 5 over 4. So that's 15,000 shares, right? We have increased the shares by 15,000. That is the nominal value. Remember, the shares had a nominal value of $1. All right. So
Yes.
We have increased the shares. Remember, here they are simply saying, in terms of what shall I say? This $12,000 is actually $1 nominal value multiplied by 12,000. Multiplied by no, multiplied by 12,000 shares, not dollars. It's just 12,000 shares. We are talking about 12,000 shares. For the share capital there, the 12,000 is $1 share. It's a $1 nominal value share multiplied by 12,000, which is the total number of shares. Then we get that 12,000 multiplied by the issuing ratio, where we said we're going to issue 5 for every 4, all right? And we get 15,000 as the share capital portion. Now, we did not issue these shares at nominal value. We issued them at a premium at $6. Instead of $1, we issued them at a premium of $6. So there was a gain of 6 minus 1. 6 minus 1. 6 minus 1. This comes to 5. So there was a gain, there was a premium charge, right? So that premium is also going to be accounted for in the share premium account. So we are going to say 12,000 multiplied by 5 over 4 multiplied by 5. So here, please do not mind this one. This dollar sign is wrongly placed. The dollar sign there is wrongly placed. Actually, it should be on 5. The 5 is the $5. This is the share premium amount. The dollar sign should be next to the 5 here. Is that clear?
Yes.
Good. So we get our 75,000 there. And so I'm sure you're appreciating that this was a compound journal. This is what is called a compound journal, where we've got, a journal where we've got more than 2 entries in one journal, that it becomes a compound. We are talking of a lot of credits or a lot of debits at the same time. Is that clear? Then there was a goodwill on acquisition. It's calculated. The goodwill on acquisition is calculated in the usual way. It follows the fair value of consideration transferred, which in this case, because we determined that the consideration was 12,000 shares multiplied by the issued ratio multiplied by the share price, and we arrive at 90. So that's the 90 we are going to use. The fact that we use the shares doesn't mean that there's no goodwill, because those shares represent money. So 90,000 less net assets at acquisition date, fair value of net assets at acquisition. Let us assume that the fair value of net assets of S company is 75,000 at acquisition. So we just have to use that amount of 75,000 and we get the goodwill of 15,000. Why did we consider the NCI and everything else? We are told here that they acquired all the shares. So it was 100% acquisition, no NCI is involved. Am I talking to somebody? You must be paying careful attention to detail as you be reading the question. Is that clear?
Yes.
I'm telling you, no more consolidation problems. We have solved them, isn't it?
Yes.
Now, sometimes they are what are called intra-group transactions. Intra-group transactions and then current accounts. Intra-group is when the parent sells something to the subsidiary or the subsidiary sells something to the parent. So issues which might arise are that receivables and payables and P&S would need to cancel one another. All right? Receivables in P&S might need to cancel one another. Dividends paid by the subsidiary recognized as income by the parent. Similarly, if a dividend is paid by one entity and received by another, the net effect of this to the group is zero. Unrealized profits on sale. This one now is very, very problematic. Unrealized profits on sales of inventory between the parent and the subsidiary needs to be taken account so that you can understand this concept further. We need to consider the following question. Can you make a profit in your right hand? I mean, if your right hand sells goods to your left hand, are you going to make any profit? Obviously not. And for the same reason, a group cannot make profit when one part of the group sells goods to another party. So the current account question, if P and S trade with each other, this will probably be done on credit leading to a receivable, that is the current account in one entity's statement of financial position, and a payable, that is the current account in the other entity. So the amount should not be consolidated because the group would end up with a receivable to itself and a payable to itself. Receivables and payables would consequently be overstated in the group as of P. These balancings are therefore cancelled. That is, they are contrad. There is need for a contra action against each other or consolidation. So to deal with the problem of unrealized profits, we do the following: calculate the unrealized profit in inventory. Remember, this profit is on closing inventory, is on the inventory which was sold by a group member to another one. And that inventory is not yet sold. So you need to talk of the profit on inventory that has not been sold out of the group. If there is inventory that was sold, that was subsequently sold out of the group, then we do not have to worry because that one is a real profit. But if we still have inventory which we bought from a sister company, that's when we need to worry about these things. Is that clear?
Yes.
So you also have to reduce the inventory and reduce the retained earnings of the company that is sold the goods by the amount of the unrealized profit. Let us look at this example. Common P has a controlling interest in S, extracts from the statements of financial position of each common individually as 31 December as follows. So P has got receivables, so as S, and payables, so as S, and included in P's receivables is $80,000 owing from S. So in this receivable, there is 8,000 owing from S, which means S should pay P. S payables include the 8,000 owing to P. So here there is also the 8,000. We need to cancel out that, 8,000. Let the total receivables and payables to be shown on the consolidated statement of financial position as at 31 December 2010. So these are the extracts. We need to remove that 8,000 from the 50,000. This is how we are removing it. And you also have to remove the 8,000 from the total payables. And these are the amounts to be left out. So in your multiple choice question, this type of thing usually come where you end up confusing yourself. So be careful. Let us deal with this question thoroughly. I think this should be our last task for the day. So I think there is a bit of typing to be done. Let me just correct this one. The figures are not aligned properly, so I might say N is not getting it when it will be an issue of, correcting the presentation of the figures. I think in terms of alignment, we are somewhere there. Yeah, in terms of alignment, we have done justice. So we have got this someone. So Pico acquired all the shares in S company 1 year ago when the retained earnings of S Corp stood at 10,000. So here we are being told that, hey, please do not forget this figure because it is very, very important when you want to compute your net assets at acquisition. And remember that working for goodwill. Remember this.
Yes.
Now, assets, non-current assets, we have got tangible assets, which are 80,000 for the parent, 40,000 for the subsidiary. Investment at cost, this is the consideration transferred to acquire S. Please, that's how you ask these questions with easy. The 126 here is just the sum of 8,000 and 46,000. We get this amount. Is that clear?
Yes.
Good. We then move on to the trade receivables, the current assets, the trade receivables for P, 30,000, for S, 25,000, inventories, 10,000, 5,000, and the 40 is the 30,000 plus the 10,000, we get the 40,000. This 30,000 is 25 plus 5,000, and we get 30,000 there. Are you seeing my cursor as I move it?
Yes. Mm-hmm.
Good. You must actually concentrate on that cursor. All right. Total assets. We are talking of because when you see the total assets section, it means that the first part of the SFP has been reached. Remember the accounting equation. Assets is equal to equity plus liabilities. This is why we have finished the asset part on top. Now we are going to the equity and liabilities. Are we talking sense to some people out there? Hello?
Oh,
Somebody is falling asleep. Don't worry. That's you need to
no,
concentrate, but
I'm still up.
you're still there.
Yeah, I'm still there.
I've heard a lot about you, talking bad about your tutor that he's very lazy, he doesn't work. But I know that when I catch you, I'll deal with you, isn't it? I'm very
Who
sorry, man.
said
Guys,
that?
sometimes I'll be busy. I'm very sorry for that. Don't tell
That's
them
okay.
that, please, man. Don't tell them. Tell them that I'm a nice guy. I do my work. You know.
Okay, I will.
Okay. Let's continue. Mm, all right, let's continue. Because if I don't show my face, some people, end up losing concentration. Um, so, what shall we do here? So we are on the equity side.
Yes,
Remember, in the examination, you need not to do all these tickings and so forth. No, there won't be any chance to do the tickings. Tickings are only being done here to emphasize certain points. All right. Now, equity
yes,
owner share capital was 100 and was 30 in the subsidiary. Retained earnings 45, 22, and there is 100 plus 45, that's 145. 30 plus 22, that's 52. Then current liabilities, we have got 21 and 18. So in a way, we need to demarcate by that line to show the SFP for the parent and for the subsidiary. Is that clear?
yes,
Okay, now during the year S Kanban sold goods to P. So it is the subsidiary that sold goods to P. And this is mostly problematic because the NCI would have required certain adjustment. But now this was an all share acquisition or 100% acquisition, which means that there is no need to worry about the NCI. Okay, good.
yeah.
Now, S sold. You wanted to ask something?
No,
Okay, so S sold goods to P for 50,000. The profit to S Corp being 20% of the selling price. 20% of the selling price. What is 20% of the selling price? That's 50,000 multiplied by 20.
percent.
That is 10,000, isn't it?
Yes,
This was the profit. That was the profit when the goods were sold. Okay?
mm-hmm.
They were sold for 50,000. Did we get the English correct there?
Yes.
I think we didn't. What was the selling price? How much was the selling
So
price?
we have to so we have to say the selling price is it has to be 40,000.
Hello?
The selling price it has to be 40,000.
How did you get the 40,000? That's the question.
The percent the profit from those goods it's 20% and of which is 10,000. So we say this 50,000 minus this 10,000.
Where are you? Is that true? Tell me, is that true?
No, it's not true. It's just a guesswork.
No, don't guess. Think. I don't want you to enter into that exam hall guessing things.
Because
Think.
it's saying during the year and
Mm.
sold goods to PCCO for 50,000, comma the profits of ESCO being 20% of selling price.
The profit of what?
The profit of ESCO being 20% of selling price. So it means the selling price is 50. It's 50,000.
Uh-huh. So
And then the profit is 10,000.
the reasoning, you are quite right. But I wanted you to be very, very sure.
Okay.
They get it. Yeah, because the question is very clear here that they sold these goods for 50,000. The profit being 20% of the 50,000. So the profit was 10,000. But now the problem is at the period end, 25% of these goods remained unsold in the inventories. At the same date, Pico owed, all right, before we go to the current accounts, let's now talk of, um, let us first talk of this intra-group, the unrealized profit. How do we treat that? 25% of the goods, that is 25% of 10,000, is still, because remember, we could do it this way to say 50,000 multiplied by 20% multiplied by 25%, and we get 2.5, isn't it? All right? Because that's 25% of 10,000 is 2.5, isn't it? Okay? Are we together? My question is, how do we treat the 2.5? See,
Okay. Sorry?
oh,
Say I cannot hear you.
you can't hear me? Mhm.
Can you hear me?
Yes. Are you hearing me?
Yes, yes.
Man, let us finish this question and we go, man. Please, please. Oh.
Okay. All
Okay.
right.
Uh, so we've done the working for the unrealized profit. Unrealized profit being profit which was made when the goods were sold between related companies, okay, or companies under the same control or group companies, right? So there was no profit as long as those goods were not subsequently bought by the external people. or external parties. So we need to cancel out that profits. When do we cancel it out? We have to remove it from the same inventory to which it belongs. So in the inventories, we are going to remove that profit. So we need to, to remember or to be in mind that we need to remove the 2.5. We normally call it power. 2.5 to be moved from inventories, right? 2.5 power. Then is there other adjustment we need to do here? At the same time, PICO owed ESCO 12,000 for goods bought, for goods bought, and this debt is included in the trade payables of PICO. So in the payables of PICO, where the payables where yes, these ones. So in this figure, in this 21,000, there is a figure to be removed, which is how much? 12,000. So we need to remove 12,000 here. 12,000. And also in the receivables, where the receivables of ESCO, receivables, these ones. So here we need to also remove the 12,000. Then we can safely do our consolidation, but there's one thing, because we bought a company, we need to talk of the goodwill. Let us do the computation for goodwill. But I was a space somewhere. All right, we can use the other this other part. For the goodwill. We know that it is fair value of consideration paid. How much was that? We paid 46,000. Then do we have any NCI? There's no NCI because we bought only the shares, so there is no NCI. So we go straight to the fair value of fair value of net assets. How much was the fair value of net assets? This is a very, very important working. We were told that there were reserves. Okay. We were told of the reserves of 10,000. If you still remember, do you see the 10,000 I think?
Yes.
And we expect that part of the equities was not going to change. That is the share capital. The share capital here, the 30,000, of ESCO was to be expected to remain the same, or is to be expected to have been the same. So the net assets at acquisition included the share capital of how much? Of 30,000. That share capital, 30,000. 30. It's been fine. 30,000 plus the retained earnings at acquisition. Retained earnings were 10,000 there, plus 10,000. My pen is no longer responsive. So 30 plus 10, we come to 40,000. So 40,000 from 46,000, it means that our goodwill, the goodwill is I want to talk to someone who is responding. Don't be quiet, man. Why are you angry? I want the network.
No, I'm not angry.
The network, man, it's not my problem. I'm very sorry. Next time I'll try to use better network. but for now, please concentrate, right?
Okay.
Um, so we have done, we will have actually taken about 4 or 5 points so far. The goodwill is there, 6,000. Then we can certainly do the financials. So let us come with the consolidated SFP, the consolidated SFP. So we start with the non-current assets. The non-current assets, we say it to be 8,000. All right. So the way I am itemizing my things is different, so it is going to cause some problem. You need to follow the format your examiner would have given you. I thought here the non-current assets had been individually listed, but instead the examiner adopted the approach of just putting them as a group. So we've got assets which have been demarcated as non-current, and so we can safely say you to just say PPE, because remember there is also another non-current asset, but this current asset is different from the other assets, which is goodwill. So there is PPE, there is goodwill. You have to smartly set it so that it is something nice, and you indicate to the examiner that it is from a working. That is the working. If you have done more than one workings, you need to put the working number. So, for example, we can certainly say this was working number 1. All right.
Okay.
Now let's start with the PPE. The PPE start with the figure for the parent. Parent get how much? 80,000. It was 8,000, and the subsidiary 40,000. Okay. So we come here and
Yes.
say 80,000 plus 40,000.
120.
At the end, there are the adjustments to PPE. There is no adjustment. Oh, so we need to talk about adjustment. So there is also one more example on this one. No, so here we come to one thing I thought I was about to release you, but if we don't talk about that one, it's not true. Then
No,
goodwill.
I'm talking.
All right.
Can
Goodwill
you
is,
hear me?
yes, I'm hearing you. What are you saying?
I was saying 120,000. I've been
Oh,
saying it.
oh,
Can you hear me properly?
all right. Okay, okay. I'm hearing you, madam. All right. So that's 120. All right. Thank you. And what was the working for the goodwill? 6,000, right?
Yes.
Goodwill, 6,000. Do we have other assets? We have got current assets. Yes, current
Assets.
assets. So this one we can call them non-current assets, right? And then we have got current assets. Current assets, we've got receivables, and we also have got inventory. So receivables, remember there is the current account. There is the current account. Okay. Receivables, we have got 30 plus 25 minus the current account. I'm sorry, I see my pen sometimes starts to misbehave. So there is 30 plus 25, 30 plus 25 minus 12.
Mm-hmm.
Plus 25 minus 12. I've ignored the zeros for
43.
now, all of the pressure. Hello?
43.
43.
Mm-hmm.
Please give me correct figures. Remember that day when
Yes, it's 43.
the other day when you gave me the wrong figures and my figures were not balancing. Now, what about the inventories? We have got 10 plus 5, 10 plus 5 minus the the provision for unrealized profit. Okay, so 10, 5 minus 2.5.
10 plus 5 minus what?
Minus 2.5. 10 plus 5 minus 2.5. What do you get?
12.5.
Yes, 12,500. So we total all these up and we arrive at the total assets. So at the down from 12.
73.5.
73.5.
Mm-hmm.
Wrong. You are adding 120 plus 6 plus 43.
Oh, it's 120. It's 181.5.
You're dangerous, but it's 0.5. So on the asset side, we are done. What about the equity side? Do you have enough space? Yes. Let's now talk of equity and liabilities. So we start with the parent share capital, the share capital. The parent share capital, but you just have to know that this is for the parent. Okay, no need to mention that this is his share capital. Safe to say, owner share capital, right? Or
Yes.
share capital of $1 each. $1 each. $1 each. How much was the capital for the parents? This was 100,000. Repeated that as it is 100. Then we add retained earnings. Retained earnings, there was no share capital mentioned here. Retained earnings, the retained earnings usually come from the working. Comes from working, but we can do the workings here because they're not that complicated. We start with those of the parent. Okay, the parent was 45,000 and the son got 2,000, but we need not to forget the pre-acquisition retained earnings. They need to be catered for. So let us do stage by stage. We start with the parent 45, then the subsidiary 32. 45 plus 22 minus the pre-acquisition 10,000. Oh, 10,000 minus the there was realized profit. Remember, are you still with me?
Yes.
Yes, unrealized profit has to be removed as well. That 2.5, the 2.5. We removed it from inventory. We also have to remove it from the retained earnings. Remember, the journal was we debit retained earnings, retained earnings or NCI. We debit retained earnings and credit inventory, isn't it?
Yes.
So we did the inventory part, we reduce the inventory. Inventory is an asset, so when we credit it, we are reducing it. Right now, we are now reducing retained earnings, okay, which is the where the profits accumulate. So we want to reduce those profits. Is there any other adjustment to the retained earnings? I think these are the figures. Please do the computation with the addition. Tell me what you find.
54.5.
We got 54.5, right?
Yes.
No need to put a point here because I'm writing all the zeros. What about the liabilities? Do you have current and non-current liabilities, or just they were just bunched? What have got current liabilities? Okay, and remember these liabilities, the current liabilities have got they do have got a current account, so we need to also remove that current account of 12,000. Remember, this 12,000 has to be, since we also treated it in a receivables, we should also treat it in payables. So that is the thing. So we are having 1 minus 12 minus 18. 1 minus 12 1 minus 12 minus 18. That's the figure we need. So that's 21. And the pen is taking long. 21 minus 12 plus 18. The 12 being, the 12 is the current account, okay? Which is
Yes.
a fake payable.
18.
So what do you get?
18.
1 minus 12 plus 18.
27, I mean. I'm still thinking about the 18,000. It's 27.
Okay, 27,000, right? All right. Now, what is the total? What is the total of 100 plus 54.5 plus 27?
381.
3, 3,
And it's 27 plus 54.5 plus 100. It's 8. It's 181.
of the extended. So that's 181. Okay,
500.
181.
It's 181, 500.
That's
Still the
500,
same with
right?
that one. Yes.
Absolutely that. So 181, 500, and that's 181, 500. Then we can claim heads for ourselves and say we have okay, there is something we need to talk about, the fair value issue, fair values. I couldn't let you go before we discuss about this thing. You might be mastering it well, but other people who might watch this video later might not be in the know. So what I'm talking about here, we are simply saying that sometimes when the acquisition is done, uh, they would realize later that when they were computing the net assets, some of the assets were undervalued. So we need to uplift their value to reflect what they really are. Right. So in doing so, we will be increasing the assets values in the statement of financial position. But at the same time, excuse me, let me drink. Are we together? Are you still there? Hello? Hi.
I'm I'm still here.
Okay, good. So I said that in as much as we will be increasing the assets in the SLP, we also have to then factor in the depreciation charge. Because the moment you increase the asset value, also have to worry about its depreciation, its related depreciation. Is that clear? So a fair value adjustment represents the amount required to adjust the relevant item for its carrying amount in the subsidiary statement of financial position to its identified fair value. So let's look at Home Bay. Home Bay acquired a 75% interest in the equity share capital of Spade on 1 January 2026. The consideration consisted of an immediate cash payment of $1.80 per share acquired, plus the Home Bay agreed to issue 2 shares in exchange for every 3 acquired at the date of acquisition. Spade had 2 billion empty shares of $1 nominal value each in issue. The market or fair value of a $1 whole per share at 1 January 2026 was $3. Calculate the fair value of consideration paid by Home Bay to acquire control of Spade and state the accounting entries required to account for the increase in share capital and share premium. So here we are having a company called Home Bay. They acquired 75%. So let us talk of the consideration first. Consideration that was transferred, because that one is a very, very important figure for our analysis. Is that clear, madam?
Yes.
That figure is very, 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 very important. So we can come back to that question which we asked, how many shares we acquired, how many shares we issued. If we are looking at this particular question, how many shares we acquired? They acquired 75% interest. And this particular subsidiary, Spain, had 2 million shares. So number of shares acquired, number of shares, I don't like it when my pen is not right. Number of shares acquired, this one is equal to 75% multiplied by 2 million.
2 million.
And what you get, obviously, that's 1.5 million.
Mm.
So the number of shares acquired is 1.5 million. Now, it's now easier for us then to do the rest. The consideration consisted of immediate cash payment of $1.80 per share acquired. So which means we have got a cash consideration. There was a cash and share for share, sorry, cash, and then so cash was there, which is equal to $1.80 multiplied by 1.5 million shares. And how much is that? $1.80 multiplied by $1.50. That should be 2.7, isn't it?
2.7. Yes.
Yes, 2.7 million, not 2.7, but 2.7 million.
Mm.
Then there was also a share for share exchange, because we were told that 2 shares in exchange for 3. So the share for share, S for S, the S for S, share for share exchange was 2 shares, 2 for every 3. So that's 2 over 3 multiplied by 1.5 million. And this comes to 2 for share multiplied by 1.5 billion multiplied by, and remember, you need to also then multiply by the share price. How much is the share price? The share price of the acquirer of the parent, which is home-based share at 1 January, the market value was $3. So you must not forget to multiply by $3, the share price. Hello.
Yes.
I don't want you to cry on exam day. Oh.
1 million.
Is that
Oh,
1
you say
million?
times 3. It's 3 million.
That's 3 million, right?
Mm-hmm.
Is it so? I'm not having a calculator here. Mine is refusing to punch, but it's 3 million. I can see it. So that's 3 million.
Yeah. Mm-hmm.
Now, so what is the total consideration? I don't like this example because it did not take me to what I wanted. But anyway, let us finish it. So the total consideration, the fair value is actually how much? 5.7, isn't it? 2.7 plus 3 million. This means that the total consideration is now 5.7 million. 5.7 million. Now, the question was saying, how are you going to treat this? What is the journal entry for this particular transaction? Obviously, we are going to debit investment. We did this one, isn't it? Debit investment 5.7 million. Isn't it so?
Yes.
And what do they have to do? We are debiting investment. The investment is 5.7 million. But the problem with that is that I thought maybe to do it in stages, but anyway, that's fine. We have hidden. This is actually the ultimate amount, but we have hidden certain. We would have hidden certain journals, but anyway, let us try. So we are saying debit investment in what? In Sept. So debit investment in Sept, and then credit what? What are we crediting now? The amount which was given out. Remember, we paid in cash, immediate cash
So,
payment of $80. So which was how much? 2.7 million, right? Credit cash,
yes. Bank.
2.7 million. Or bank, credit cash or bank. What about the aspect of shares issued? We issued out shares. How many shares have we issued out?
3 million.
No, 3 million includes the share price pay.
Isn't
Includes
it 1.5?
on 1.5 are the shares which we acquired. This was the number of shares
Oh,
acquired. What about the number of shares issued? So
2
we
million.
are eh? Hello?
It's 2 million.
No, you're no longer reasoning. To get the shares, the ordinary shares issued, ordinary shares issued, I said we used the fraction. That was 2. We issued 2 for every 3, multiplied by the number of shares, which we acquired. Number of shares acquired. Hello? Number of shares acquired. We acquired how much? 1.5 million.
Mm.
2 for every 3.
So 1,000.
Huh?
So 1 million.
That's 1 million, right?
Mm-hmm.
1 million. It's a very important figure, this 1 million. So, for the ordinary share capital, we then ask ourselves, what was the nominal value? The nominal value was $1. All right, $1. So, obviously, $1 multiplied by 1 million, we come to 1 million. This is another credit entry. Then, the other credit entry we need to make is the share premium. There was a premium, there was a gain when we issued the shares because the nominal value is $, but we issued them at $3. So we then have to say 3 minus 1 million, or 3 minus 1, the nominal value, we then get at $2 premium. There's a $2 premium. So $2 multiplied by a million shares. Remember, we said we issued 1 million shares, which we determined here, isn't it? We issued 1 million shares. So 2 multiplied by 1 million shares, we come to 2 million. So this is, if you add these 3 figures, you must get the debit entry there. So this is the credit entry. Are we together?
Yes.
Good. But
Yes.
this was an example. I didn't want to do this one, but anyway, we did it. So let's move on. I want an example where we do the fair value adjustments. Okay, fair value adjustments on PPE. That's what we only want. We want to do the working for this one. Below are the statements. Okay. Hazelnut acquired 80% of the share capital of Peppermint on 1 January 2023 for cash consideration of 1 million. At the date of acquisition, Peppermint had retained earnings of 125,000 and a revaluation surplus of 100,000. So at the date of acquisition, they had retained earnings of that and revaluation surplus of that. At acquisition, the fair value of Peppermint's plant exceeded its carrying amount by 200,000. At the date of acquisition, the fair value of the 20% non-controlling interest in Peppermint was 380,000. So calculate the fair value of net assets of Peppermint at the date of acquisition and at the reporting date. So they want that table where we have got the information at acquisition and information at reporting date. Can you come up with it? You want to give it a try?
Okay.
I want you to replay this video. You see, the problem, you do not replay the tutors' videos. Maybe they are boring, but please, for the purpose of you passing, just forget about the grammar. Just concentrate on the sense. Concentrate on the
Okay.
sense. Please.
All right.
Nyakela, kakulu. All right, so that's working number two. This is normally working number two. The first working is the group structure, but I say it, the issue of drawing is no longer required, or you are no longer required to come up with any drawing. So we are now starting with working number two, which is the net assets at acquisition. Net assets at acquisition. My whole Saturday is gone. So we are talking of the date of acquisition and at date of reporting. I know when I grumble, when I see you like, hey, I want you to teach me, I sometimes run away, because I know, hey, there's a lot of work to be done. Oh my God. So I told you, when you're doing net assets, please know that the share capital is also part of it. Share capital, sometimes share premium, retained earnings. You know, say retained earnings. Here there was something like a revaluation surplus. Okay, revaluation surplus. All these you obtained as you were reading. You obtained this information as you were reading the question. Now, we need to pick the figures. Let's start with at acquisition. Go systematically, slow pace. So, for the share capital, inside here, inside the story, they didn't talk of the share capital. So where are we going to get that figure? We get it from the, the statements of financial position, and we go straight on Peppermint, which is the company which was acquired. And we go to their share capital and say, share capital, where are you? So we find that it is there, 400. Like I said, only share capital and share premium should be presumed not to change, but these other ones, they do change. As you can see here, the revaluation surplus is 100 on a reporting date, but in the notes, it was, okay, it was 200, which means it did not change as well. But sometimes it would have been very low and it increases as revaluations come by. Is that clear?
Yes.
Good. So now, let us take, first of all, the 400 share capital there, which was there. And we expect this one to remain as it is even on reporting. Then the revaluation, as we have already seen at the acquisition date, it was 200, and on reporting 100. Let me put my figures in thousands here, dollar thousands. Okay. Is the red visible that side? The red color, is it visible?
Dollar
Hello?
each.
Hello, are you seeing the red pen? Are you seeing the red color? Is it visible?
Yes.
All right, good. Let me try to use a much brighter color. Now, for the retained earnings at acquisition, they were 125. So we're going to put 125. And on reporting, how much were they now? On reporting, they were now 300. You can see that they have changed, isn't it? So we put 300, the change. Okay, then there was a story which they talked about a certain item of property. A certain item of property whose uh, fair value had exceeded the carrying amount. had exceeded the carrying amount by 200,000. So we need to factor in that one. So we come here and say fair value adjustment or fair value uplift, fair value adjustment. Hey, I don't like this color. Fair value adjustment. Fair value adjustment, which was a 200 million. There was a fair value uplift. Okay, there was a fair value uplift, and now let me just say, suppose this plant, suppose the plant was going, all right, before that, let us finish the question. Let us not reset a new question. Let us first finish this one, and then we talk what I want. Just remind me. So the net assets will come to, do you still have your calculator? Hello?
Yes.
Yes, give me the figures, the totals.
The first one here is 825. We have 400, 125, 100 plus 200. 825.
Then the other one,
It's 1000.
yes. Now we have done the the net assets working, and this one is where this one is essential for the computation of goodwill. Remember, goodwill, we said fair value of consideration, add NCI less the net assets. But sometimes if the subsidiary is 100% acquired, okay, is a 100% subsidiary, then we simply have to ignore the NCI because there won't be any NCI. So you simply say fair value of consideration minus the net assets at acquisition, and you get your goodwill. But what I wanted to talk about in relation to the fair value adjustment is that sometimes you'll be told that this plant which has been revalued, or whose fair value has exceeded the carrying amount, is to stay for a certain period, is to be useful for a certain period, for say, let us say 5 years. So if it is going to be there for 5 years, it means that it needs to be adjusted for depreciation. So you come back here to these net assets and say, if you plant were going to be there for 5 years, it means that there is what is called excess depreciation. Excess depreciation is actually treated on this same table, on this table. So the excess depreciation is going to be the 200 million divided by the number of years, which is 5 years. All right. And we need to charge this. How much per year? We are going to charge 40,000. So in this first year, we'll put our 40,000 here as a negative figure, which means our net assets at reporting will come to 960. Are you seeing that?
Yes.
Now, you may ask and say, why didn't you put the 40 here? We cannot put 40 at acquisition. Why? Because you cannot depreciate something you have bought today. So on
Yes.
acquisition, there was no depreciation. But at the end of the year, there was depreciation. Am I talking sense to somebody?
Yes.
Good. I'm sure I have covered this part because I know that it is very, very problematic. Okay. Um, Sometimes you may be asked about these, associates. All right, associates.
Mm.
I say that an associate is where we have got between 20 and 50%. Between 20 and 50%. Hello?
Yes. Yes.
I told about this, isn't it?
Yes.
So in that situation, please do not be puzzled. But how do we account for associates? Associates are not going to be accounted for in the same way we accounted for subsidiaries. Okay, we use what is called equity accounting, a method where the investment is initially recognized at cost and adjusted thereafter for the post-acquisition change in the investor's share of net assets of the associate. The effect of this is that the consolidated statement of financial position includes 100% of the assets and liabilities of the parent and subsidiary entity on a line-by-line basis. So, the shareholding of the parent and subsidiary is the one we are going to see, is the one we are going to see as consolidated figures. But now, a single investment in associates line within the non-current assets, which includes the group. So here, because we are not going to see the subsidiary, remember, where is that, which we did, the SFP, which we did, is it gone? I'm sure it's gone. Oh man, good, yes, it's still there. All right, if we have an associate, remember the subsidiary is not seen here. Why? Because the assets for the parent and the subsidiary were merged. Do you get it? But
Mhm.
when it comes to the associate, you will see an associate here. Investment in an associate will be put here. And we do equity accounting, which simply means that we will include the cost of the associate, the amount which we use to buy the associate, plus any post-acquisition profit or share of profit minus any impairment if that associate is considered to have been impaired. All right, we'll talk of impairment. Impairment is just after depreciation, we might realize that the asset is further depreciated. That further depreciation is what you call impairment, right?
Mhm.
All right. So in equity accounting, we say the cost plus any post-acquisition profit, share of profit. So if it is a 28% associate, we simply have to say, if the associate made a profit of say 100 million, our share would be 100 multiplied by 28%, and this would be 28 million. And we take that 28 million as part of the value of the associate. So which means the cost, the money we use to buy the associate plus that post acquisition share, that is equity accounting. Are we together?
Yes.
Oh yay. So we talked about these items. Do we have an example? So the consolidated SFP is prepared on a normal line-by-line basis. What we talked about that. So the associate is included in one item. There should be just one line to say investment in associate. And I said we include the cost of the associate plus the share of post acquisition, the 28 million I talked about, less any impairment, less group share of the PEP. Okay, if the associate sold something to the parent, so that is also going to be considered, is to be deducted, and we arrive at that amount which is going to appear in the statement of financial position. Um, let's look at this example. PEP company acquires 25,000 of shares of the 100,000 ordinary shares in ARGE, in age or ARGE company for 60,000 on 1 January 2028. In the year to 31 December 2028, each company earns profits after tax of 24,000, from which it pays a dividend of 6,000. So it also paid a dividend. This company paid a dividend of that amount. So the question now is, how will each results be accounted for in the individual and consolidated accounts of PEP company for the year ended 31 December 2028? How do you account for that? Uh-huh.
Can you
How do you solve this question? What is your suggestion to this question?
say
Hello?
can you hear me say?
Yes, I can hear you. I'm saying, how do we account for this transaction? Hello? Okay, now using the template here, we just want to use this template. So let us just slot in the figures on the tablet. Let us slot in the figures on the tablet because we are using equity accounting. The equity accounting method. We first start with the cost of investment. What is the cost of the investment? They paid 60,000. So that's the cost of the investment. The investment is 60. Then the share of post-acquisition profits. What was the share of the post-acquisition profits? Each company earns profits after tax of 24,000, from which it pays a dividend of 6,000. Hello? Andy? Andy? Hello, Andy? I'm saying, using the template, we say cost of investment. Cost of investment, this is 60,000. Then add share of post-acquisition, the post-acquisition share of profit, the associate made the profit of 24,000 multiplied by the share by our shareholding, and this time, and this is 25%, because that's 25,000 shares were acquired over 100. So 25 over 100, that's 25%, isn't it? That's a quarter, isn't it? That's 25%. So a quarter of this, that's 6,000. this associate paid a dividend. What shall we do with the dividend? Do we add the dividend or we deduct the dividend? Dividend is deducted. Dividend deducted. And how much is the dividend which this associate paid? It paid 6,000, yes, but how much in terms of our share? That's 25% multiplied by the dividend, which is 6,000. So 1.5 is going to be deducted, and we arrive at the investment in associate. 60 plus 6, 66 minus 1.5, we come to 64.5. This is the investment in associate. So that was the computation. Equity accounting is available for consolidated accounts and individual accounts. A company only has to prepare consolidated accounts if it has one or more subsidiaries. So if a company only has got an associate, that's not consolidation. The accounts it prepares are not going to be considered consolidated accounts.
Hello?
Hey, Auntie.
Sir, can you hear me?
Yes, I can hear you. I can hear you, Auntie. We're just
Hear you well.
Hello?
I cannot hear you well.
All right, Auntie. Let me just finish. I'm sending you the recording. I'm sending you the recording, Karen. I think today, end of day, you would be having this recording. I'll send you all. I'm just winding up. Is that clear?
Yes.
Yeah, don't worry, don't worry. I'm just finishing. I'll send you the recording. So if a company has no subsidiaries, then it is not required to prepare consolidated accounts, and so any investments in associates can be accounted for as an investment at cost or by using the equity method in the parent company's individual accounts. All right, let me just check if there is something we didn't talk about. I'll prepare a video on those other aspects, especially the statement of profit or loss. But in the examination, please just to know that these things will come, and there is going to be a pre-populated spreadsheet in most of these questions, and you just have to know where to slot in the figures. There is going to be a pre-populated spreadsheet. So I'm going to do also another video where I would attempt a question with a pre-populated spreadsheet so that you know how to work around with it. I think that is enough for now. Thank you so much.